Well, I would like to welcome you all to the Learn and Grow series today. Once again, we are here. It's a bi-weekly meetup, and I love to see you every other week. I'm a real estate investor, and every week I try to bring an awesome guest with lots of information to share with you all. And today our guest is my good friend, Charles Seaman. Charles is a managing partner of Cashflow Champs. He's responsible for building and maintaining broker relationships and performing companies' underwriting activities. He is also involved with contract negotiation and capital raising to make sure that the deals close in timely fashion. He also participates in asset management. He is currently a general partner in 8 multifamily properties, totaling 691 units, and he went full cycle on one deal, which was 92 units. And today our topic is how to underwrite multifamily deals. A small little disclaimer. This session is strictly for educational purposes and should not be considered as a legal, accounting, or investment advice. This session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The strategies mentioned in this presentation may not be applicable for everyone. The information presented is believed to be accurate and reliable. We make no representations or warranties expressed or implied as to the accuracy of such information. We explicitly disclaim all liability that may be based on such information and/or errors or omissions thereof. Please consult with your own attorney, financial advisor, and CPA for legal matters, investments, and tax situations. This session is strictly for knowledge sharing only and for educational purposes. Welcome again, Charles. Stage is all yours.
Thank you. Thanks for having me. So why don't we dive into it? We'll start here with an overview of a presentation. And what we'll do from that point is we'll dive into a live underwriting, because tonight's topic is how do you underwrite multifamily deals? So what we'll do is we'll go through a high-level overview, and then we'll mix that in with some real life action so you can see what it looks like in practice. Okay, so the agenda we have here for tonight is on the slide, and we'll start going through. First thing here, for anybody who's brand new, what is underwriting? Underwriting is the analysis of the property's income and expenses to assess the financial viability of the deal. In layman's terms, we're seeing whether or not the deal makes sense, financial sense. Okay, so next thing we have is a brief introduction to underwriting. So first thing you need to do is find a tool to use for your underwriting. You could use one that's out there. There's many of them on the market, or you can make your own. For me personally, I use Michael Block's syndicated deal analyzer most times. But if you're inclined to go out there and make your own, I know a lot of people that do that, and they customize the fields to fit whatever they want to see. Second thing is you need to get a rent roll and a T12 from the broker or the seller. So for anybody not familiar with the term T12, those are your financials. Essentially, it's an income statement. So the T stands for trailing, the 12 stands for the number of months. So if you're getting a T12, you're getting an income statement broken out by month for the last 12 months. Now, keep in mind, guys, as you're looking at different properties, you'll see that owners and management companies maintain financial records very differently in some cases. So the smaller the property, the general rule of thumb is that you're dealing with an owner or a management company that's probably less sophisticated. And what that means is they may not have a T12. You may only have an income statement, or otherwise referred to as a P&L. So you'll see that may be what you get. So you have to use what you have. If you're looking at a 300-unit community, then there's a good chance you're probably going to get very detailed financials, because you're dealing with a much higher level of owner and property management company at that point. Okay, so the next thing you'll do is you're going to take the existing numbers, income and expenses, and you're going to transpose them into your underwriting tool. So you'll enter the income on a T3 annualized basis and the expenses on a T12 basis. And the reason we do it this way is because this is how most lenders look at it. So you always want your underwriting to be as close to the way a lender is going to look at it as possible. The last thing you want to do is think you have a good deal and have the lender tell you otherwise. So always make sure you're using that perspective as you're looking at your numbers. Okay, so what do you do after you finish your initial underwriting? So this will vary a little bit depending on the deal that you're looking at, but most of these steps will be fairly similar all throughout. The first thing you're going to do is reach out to the broker, or if you're going direct to seller, reach out to the seller with any questions you have about the deal. So for me, all of my deals come from broker relationships. And because of that, having communication with them on an ongoing basis is very important. So if you're looking at deals that are coming through broker relationships, then I'd recommend that you get back to them with some feedback. My feedback is usually in the form of questions. If you're dealing with the seller directly, you want to understand their situation. You want to understand a little bit about them and their motivation for selling the property. And you want to ask questions that may help you negotiate a deal. Next thing you want to do is reach out to your property manager, get their opinion on the deal, and see if there's any opportunity to increase income or reduce expenses. So keep in mind, guys, there's multiple ways to improve operations at a property. So a lot of people think increasing income. And while that is an important one, reducing expenses is just as effective. At the end of the day, both items increase your NOI. And the end goal as an operator is to increase the NOI, because by doing that, it makes your property more valuable. Okay, so the next thing you want to do is reach out to a mortgage broker or a lender, and you want to get a financing quote. So if you're just starting out and you don't have any deals closed, you'll probably have more success going to a mortgage broker. Oftentimes, the lenders are going to want to deal with the KPs, and they'll want to deal with people that have histories of closing deals. So when you go to the mortgage broker or the lender, you're typically going to present them with the financials that you have for the property. You're going to let them know what the purchase price is. And then at that point, they'll be able to look at it and tell you what you can get in financing. They'll usually tell you how much you can get in proceeds, what type of interest rate you should expect, and what your amortization period will be, and also if there's any interest only. Now, keep in mind, guys, when you're getting any of this information, whether it's financing, whether it's insurance, these are only estimates. So when you're doing your underwriting is built on assumptions. So some assumptions are going to be right, some assumptions are going to be wrong. So it's a starting point that gives you a framework for a deal, but it's not necessarily how the actual finished product may look. Just keep that in mind. Okay, so the next thing is similar to getting a financing quote, you're going to get an insurance quote. Now, when you're early in the process like this, you're not going to get a formal quote, because that requires the insurance broker sending the deal out to multiple carriers and really working a long process. What they're going to give you is what's called an indication or a soft quote. And that's based on the limited information that you provide them with at that time. And they'll take that information, and based on the property and the condition of the property in the area, they'll give you a rough insurance number so you have something to budget for your underwriting. Okay, so and then we have number 5. Now, guys, in case it wasn't clear from the capitalized and bold and underlined text in number 5, this is pretty important. So taxes. This is a major mistake. I see a lot of people make it. It can be one that can have a tremendous impact on the deal. So you need to reach out to the assessor in the county where the property is located and find out when the assessment is going to occur, how it's going to be calculated, and whether or not a sale is going to trigger an automatic reassessment. So some areas are what they call point of sale areas, which means that once you have a sale, it's automatically going to reassess. Some areas aren't. Why is that important? Ultimately, the tax assessor is going to get their money at some point, but the difference between sooner or later is going to impact your numbers and the financial performance of your property. So for me, I look in some of the Southeast areas. My primary focal points are the Carolinas. So I know that, North Carolina is not a point of sale state. So that means that when I buy a property, it's not going to have an automatic reassessment triggered. But I know that South Carolina is. So if I buy something in South Carolina, what that means is the assessor is going to come get their portion of that gain as soon as possible, so they can give me an increased assessment and charge me a higher tax bill. Okay, then the last thing here is updating your underwriting. So again, assumptions are what really is the basis of underwriting. After you start out with the initial assumptions, you want to update your underwriting with the new assumptions and the new information you have, so that way you're able to determine whether or not the deal makes sense. With your initial underwriting, most times you're not going to be able to tell if a deal makes sense because there's too many pieces of the puzzle you're missing. Yeah, so do yourself the process and work through it. And then from that point, you'll be able to get the information you need to make an informed decision. Okay, so another thing that's important, and you'll hear this term often with underwriting, is stress testing. So especially in today's market where there's a lot of uncertainty and a lot of investors are getting nervous, people are very cautious because they want to make sure if they're entering a deal, they're getting into a good deal. And there's a lot of different things you can stress test. So on this slide, we have some of the major ones that are very important. So I would say the single biggest one, and perhaps the most relevant one right now, is terminal cap rate. So for anybody not familiar with underwriting, aside from your purchase price, your terminal cap rate is the second most important factor you're going to have. So unfortunately, you can see times where you go in there and you do a great job operating the property, but simply because you had a terminal cap rate that was unrealistic, or because market conditions changed and maybe not for the better, you may have the market conditions working against that great performance you have. So what that means is if your terminal cap rate is too aggressive and it's something that's not realistic and achievable, you may have a much different result than what you anticipate. So one thing you'll want to do is stress test using multiple terminal cap rates and see what does the return look like if we sell at this cap rate or this cap rate. And you may want to try 5 or 6 different terminal cap rates so you can see if you're satisfied with the return. You know, for every deal, there's a price at which the deal works, and for every deal, there's a price at which it doesn't. So just understand what the likelihood of terminal cap rates changing are, and make sure that you're using one that gives you plenty of cushion. So always stress test those. Second thing is net operating income. So aside from terminal cap rate, your net operating income is the other really significant factor as you're going to sell an asset. So you want to make sure that the property is set to perform. Sometimes things don't go as well as we expect. That happens. It's called life. So you have some assets that perform really well. Maybe you exceed the expectations you have. You have other assets that perform, just as good as you projected, and you have some that project worse than you project. So stress test the NOI and see where that breaking point is. Now, it doesn't mean that you're not going to do a deal just because an extreme stress test doesn't look good, but you want to understand what that breaking point is, so that way you can run the deal properly. You can buy the deal with confidence, and you want to convey that to your investors by also giving yourself some leeway as you run the asset. So next thing is annual rent and expense calculations, and essentially escalations, I should say. So essentially with these escalations, what's going to happen is they're going to be an important part of your returns, because if you're projecting 5% income growth and you're projecting 3% expense growth, and then all of a sudden you see something drastically different, that could alter your returns. In most cases, you'll probably see me use 3% on the rent escalations and 2% on the expense. Those were historical norms, but at this point, when I say historical norms, it's probably not that. It's probably further back historical. For anybody keeping an eye on the market in the last year or two, we've seen some really crazy numbers that are probably not likely to continue in the future. So just keep that in mind. Test out different escalations and see what the returns look like. So again, you can see where that breaking point is and understand what the probability of something you're projecting not working out is. Okay, so another point that you want to look at is mortgage interest rates. So for anybody who's been looking at deals in the last few months, or even watching the news, or just being abreast of what's going on in the world, you're probably aware that interest rates have been increasing. It seems like every time we turn around, they're a little bit higher than they were last time. So it's something to be aware of. A lot of times, from the time you get awarded a deal at this point until the time you close it, if there's a 60 to 90 day window of time in between, there's a good chance that rates are going to be higher by the time you close than when you first look at it. So you want to stress test it again. Where is that breaking point? If interest rates go up 50 basis points from that initial underwriting, can you still go through with the deal? If they go up 100 basis points, can you still go through with it? So understand where the breaking point is, so you know whether or not the deal makes sense, because it's very common right now where proceeds are getting cut, rates are getting raised, and these are just byproducts of the market conditions we're in. So you want to understand where that breaking point is. And the last one we have on here is break-even occupancy. So what does break-even occupancy mean? That means that's the lowest level of occupancy the property can have and be able to support all of the operating and non-operating expenses. In short, you're not making money, but you're at least breaking even. So for most properties, you're probably going to see that between, maybe 50 and 80%. If it's north of 80%, I would tell you probably want to be cautious, and there's a good chance you're paying too much. The lower that break-even occupancy is, the better, because it gives you more cushion. So just understand where it is, so that way you know what your risk is with the asset. Okay, so recent changes to consider when underwriting deals. So if there's one thing we've had a lot of this year is change. A lot of change. We're in evolving market conditions where as soon as you think that you know something, it changes. So make sure you're staying abreast, make sure you're speaking to people who are in the field every day, make sure that you're keeping abreast of Fed meetings. So that way you're aware of what these changes are and how they might impact our industry and our duty here as multifamily real estate investors. So the first one, which is also a reiteration of what we discussed on the last slide, interest rates are rising. So right now for long-term fixed rate debt, you're probably somewhere in the 5 to 6% range for most multifamily properties. For me, my preferred form of financing is agency debt, which is a Fannie Mae or Freddie Mac backed loan. And with those, a lot of times I'm seeing them hover somewhere around the 5.5 rate at this point. Now, keep in mind, these rates are going to keep evolving. If you're looking at bridge debt, there's a good chance your rates are going to be higher than that. So there's adjustable rate bridge and there's fixed rate bridge. And if you're on the adjustable side, you're probably starting in the high 5s and low 6s. But keep in mind, if it's adjustable, those rates can also increase throughout the life of the deal. So they're going to very much mimic the real life movements of the market at that time. And if you're doing fixed rate bridge, you're probably in the mid 7s at this point, because the lenders are giving themselves some cushion because they expect rates to go up. Okay, so next thing is cap rates are starting to decompress. So the last couple of years, we've seen a lot of cap rates compress. If anybody here has been watching the market, maybe you've had similar reactions to what I have, but I know that every time I look at deals, I say, wow, how much further can cap rates compress? Well, I think we may have finally found the answer. So we're at a point now where things are starting to reverse and they're decompressing. And in most markets, that decompression has been fairly mild. But keep in mind, guys, there's a reason for that. Why has it been mild? The reason it's been mild is because cap rates are based on deals that close. So it takes commercial real estate transactions a while to close. Things don't happen overnight. You're not going to see cap rates change overnight. But what you'll see is that there's deals under contract right now that are going at higher cap rates than they were previously. So that means as those transactions close, or if they close, you're going to start seeing cap rates become higher and higher in different markets. So as we said in the previous slides, NOI and cap rates are really the important parts of your equation. So even if you increase your NOI, if your cap rate's decompressing, then you may not quite get the return you're hoping for. So just be aware of that as you're looking at deals. So for institutional quality assets, and when I say institutional quality, these are generally newer, larger assets. So they're probably 2010 build assets in bigger cities on major streets that are 300 unit properties. Prices are staying fairly close to where they were. They are coming down a bit, but we haven't seen significant drops yet. Value add assets, there have been some more significant drops. In some markets, they're as much as 20% already, and they're still going. We're not done yet, guys. If you're using adjustable rate bridge loans to acquire deals, that means your rate will change from month to month. So it's going to very much mimic the market. There were 4 deals that I closed earlier this year with adjustable rate bridge loans. So just to give you a real life example, one of those loans, when we first closed it in March, that the interest rate was 4.17. As of this coming payment, we'll be up to 6.20. So keep that in mind, guys. There is a spread, and unfortunately, as rates rise, so can your rate on that loan. If you're using an adjustable rate loan, expect that you'll need to buy a rate cap. Generally, most lenders are going to require that now because they do see a lot of risk with the adjustable rate loans, and they want to make sure they're protecting both themselves and you by having you buy a cap. So what the cap does is that limits the amount of risk and exposure you could have if rates continue to go further. So there's a link in here that's Chatham Financial. What I would do is I would recommend using that link if you're using adjustable rate loans, so you can get a rough amount for that cap, because you want to include that in your underwriting. So similar to insurance, the caps are priced based on risk, and they're priced based on exposure. Right now, the cap providers have a lot of risk and a lot of exposure. That means you're paying a lot of money on the front side to get these caps. So you want to make sure you have a solid number in your underwriting, because there's multiple times this year that I've seen these caps go 7 figures. So just keep that in mind, guys. 7 figures is a lot of money. And if it's something you don't have factored in your underwriting, it's certainly going to impact your returns and what you're able to pay for that deal. Okay, and then also one more thing, if you're using adjustable rate loans, make sure that you have a debt service reserve built in. So most lenders are requiring anywhere between 6 and 12 months of debt service, and that's excuse me, that's something they're holding back from the loan proceeds at closing. And the reason they're doing that is because the property may not cash flow well enough as you're stabilizing it, if it's a value add, to be able to support the debt. So the lender wants to make sure there's minimal risk of the deal going underwater, and they keep that reserve there to be able to offset the mortgage payments for any months that you're not able to. Okay, so what we'll do here is in the slides, we do have some information with the syndicated deal analyzer, but instead of going through the slides, we'll actually go through an actual underwriting. So that way you guys can see what it looks like in practice. So this particular one's for a deal that I'd underwritten fairly recently. And you'll see here it's a 216 unit deal. And what we'll do is we'll go through how this works in practice. So let's take a peek here. Okay, so what we have in scenario 1, for anybody not familiar with the syndicated deal analyzer, it has different scenarios. And for me, I really use scenario 1 and scenario 4. So scenario 1 is the seller's numbers, and we're taking these numbers from the T12 and we're putting them into the underwriting tool. And scenario 4 is my pro forma for how I would plan to run this particular deal. Okay, so let's take a peek here. We also have our T12 up. So let's do a quick overview of this just so everybody understands what we're looking at. So keep in mind, you'll see here there's data for 12 months. So at the top here, they have each of these months listed, so you know which column belongs to which month. And what you'll see is they have income and expenses. So this here is a larger property. This is an institutional style asset. And you'll notice the financials are a bit more detailed. So they have items here in the income for rent, which essentially is this is your gross potential rent, or your market rent as they refer to it sometimes. And you have different things like loss to lease, vacancy, model units. So these are all different types of collection loss items. So many financials typically start with a gross number up top. Then they'll have all of your different rental loss items right below it. And then they typically have all of your items of other income. So for this particular property, they're getting other income from late charges. They're getting pet rent. They're getting all different things. You'll see utility reimbursements. So many of these items are typical for different properties. And what you'll see is newer, larger properties generally have more and more sources of other income. So a lot of the luxury apartment buildings that are being built or that were recently built have no shortage of amenities. And in many cases, the property owner is charging the residents to enjoy those amenities. So because of that, it brings in different streams of other income. So you'll notice here on the right side in column O, so this is actually something I had added, and I had taken all of the income items and I did them on a T3 annualized basis like we discussed. So what you'll see here in this particular formula, I'm taking the last 3 months that are available, which in this case here is May, June, and July. I'm doing a subtotal of those 3 numbers, and then I'm multiplying it by 4 so we get an annualized total. So you'll notice with each of the income items, you'll see that same formula all the way down. And the reason for that is because you want to make sure you run your income in this manner. And Angel's asking, I don't feel that using an annualized T3 is a little aggressive. It doesn't matter what I feel. That's how it's done in the industry. So that's generally how lenders look at it. So most lenders are going to look at it from that perspective. So we want to look at it from that same perspective. So, you know, it's kind of one of those things like when you stick the key in the ignition of the car, it goes. You know, my thought is I could sit there and analyze it, but if that's how they look at it, we want to look at it from their perspective. So, okay, so what we'll do is we'll go back to the syndicated deal analyzer. And what you'll see is that I already inputted the items here just to save some time before the live streaming here. But we want to make sure our numbers prove out. So as we look here, we can see the effective gross income, which is our total income received, is $3,663,855. So you want to come back to your trailing 12, and you want to see if that number matches up, so we know if we did everything correctly. So over here we have $3,663,854.68. And aside from just the rounding issue, just because one has decimal places and the other doesn't, that evens out. So keep in mind, guys, as you're doing your underwriting, it must match up. If it doesn't match up, take a few minutes to go back and see where the error is. Now, if you're $1 or $2 off, I'm not going to tell you to spend half an hour and find that, because it's probably irrelevant when you're looking at a deal this size. But if you're something that's, $50, $100, $200,000 off, take some time and find that, because that can really impact your underwriting. Okay, so then on the expenses. So you'll notice that the syndicated deal analyzer, as well as any other underwriting tool out there, they're going to have default expense categories. So in the syndicated deal analyzer, they have advertising, contract services, gas and electric, general admin, insurance, legal, real estate taxes, trash removal, management fee, payroll, repairs and maintenance, turnover, and water sewer. So everything we see on the seller's financials is going to fall into one of these items. And if you're using a different underwriting tool, you may see some different categories, but in general, most of these are fairly standard. So what you're going to do is you're going to go to your T12 and you're going to go through each of your expenses. And with those expenses, you're going to take them and plug them into whatever category you feel they fit in. Now, keep in mind, guys, while it's important to put things in the right category, it's far more important to put them somewhere. If you're brand new and you're just starting out and you don't know where something goes, put it somewhere. The worst thing you can do is leave it out of your underwriting, because then that's going to alter your underwriting. So the benefit to putting things in the right category is you can look at things and from a bird's eye view say, okay, something looks high, something looks low, and that's the benefit of having them in the right categories. The worst thing you can do is leave it out, because that's going to make your expenses lower than they should be, and that's going to make the deal look a lot better. So stick it somewhere, and then you could always go back and change it after if you feel that you're putting it in the wrong spot. Okay, so similar to the income, you want to make sure your expenses prove out, and you want to come down and look at the total of the operating expenses and make sure they match up. So over here we show $1,235,926, and you'll notice here there's a slight discrepancy. The discrepancy here is actually for the replacement reserve. So this technically is what they call a below the line item. In the syndicated deal analyzer, they do show it above the line. So that's why you'll see me just delete that number momentarily to see if we prove out. So being the numbers prove out, you're in good shape and you can keep working forward. Okay, so now you've entered your numbers. So what do? So next thing you do is you project forward a little bit. So for me, what I did is I went through some rent comps that I saw for the area. I went through some expertise just because I have some knowledge with the area. And I figured out where I could push rents to. So you'll notice here there's a little chart called target rent analysis. And with this target rent analysis chart, what this is a bird's eye view of the unit mix and also the current and the target rents. Now, everybody's going to do their underwriting a little bit differently. So for me, my target rent is my big picture. Now, that doesn't mean I'm going to hit it in year one. If you can hit it in year one, great. But in this particular property, we have money in here for upgrading units. We have 216 units. So the reality is we're probably not going to achieve these numbers in year one. So what I did was I figured out how long it would take me to achieve that target rent. And then I split it based on how much time it's going to take. So I put a little bit of that into each year. And Ali's asking a question if the numbers not matched in the marketing package and the T12. So if the numbers don't match, Ali, what you want to do is spend some time so you can figure out where the mistake is. And again, if it's a small error, $1, $2, even $1,000, $1,000 is fairly insignificant in a deal this size. I probably do it just because I'm anal. but I wouldn't tell you to go there and waste time on it. Don't spend a ton of time finding that. But if you're a significant amount off, then what you should do is go back to the financials and just compare to what you entered in the underwriting tool and see where that error is. Okay, so as you work forward in your pro forma, so there's a couple things you want to do. So one is on the income side, you want to look at the comps, you want to use the knowledge you have, and you want to also use the knowledge of the property management companies that you're building relationships with to figure out where you can push rents to. Now, the expenses, you want to do the same thing. So property managers are going to be a great resource because brokers are the experts when it comes to sale-related information. Property managers are the experts when it comes to rental-related information. So keep in mind, guys, they're going to be in the trenches every day. They see what's going on. You can look at rent comps, you can look on Zillow, you can look on Rentometer. None of those things are going to be as accurate or as real time as speaking to property managers who are doing this every single day in the know. Because every one of those data services takes time to update. So when you're looking at something, it's automatically stale dated. So speaking to somebody who's doing it can tell you what they're seeing in the field right now and things that may not actually have hit the data services just yet. Same thing on the expense side. So a lot of times I'll pick the brain of the property manager that I'm working with to see what we can do if there's room to improve on the expenses. So you'll notice here some changes I have. You'll notice a lot of the numbers I'm leaving similar to where the seller has them. And the thought process there is that I'm probably going to run them fairly similar unless I see something just grossly off. But even if I see something that I think is grossly off, before I make that change, I'm going to speak to the broker and find out why. Or if you're going direct to seller, speak to the seller. So you want to have context. The last thing you want to do is arbitrarily make changes because that can lead to you making something that you may not really be able to hit. So in this case, one thing that jumps out to me is for the area this property's in, I noticed the payroll's a little bit high. It's at $1,589 per unit. So I could cut the payroll. I could say, okay, well, I know this is high, I can do better. But let me ask you a question. For anybody in here that has a job, if you've ever had a salary cut, do you work just as good after your salary's cut as you did before? If the answer to that question is no, then I wouldn't cut the payroll. So if you're planning to retain the existing staff, you probably want to keep that number in. If you're going to bring new staff in, then that's different, and maybe you can get a lower number. You'll notice my insurance number is also a bit higher. So the seller had a number here that was at $735 per door, and I bumped it up to $900. And this particular property, I believe, is in a flood zone. So that's going to bump the insurance premium up. And in general, your number is probably always going to be higher than the seller's because you're most times paying more for the property than they did. What that means is you're going to have a higher amount of property insurance coverage that your lender is going to require. And because of that, you need to make sure you have money in your budget to account for that. So just a couple little tidbits as you walk through this. Okay, so that's on the scenarios tab. So now if you're using the syndicated deal analyzer, the next thing I would do is I would come to the summary tab. And the summary tab is going to give you the option. So there's actually 8 scenarios here. There's 4 that are hidden. So if you really want to go into different scenarios, you can play with them and see if then scenarios, what happens. I don't typically go that far myself. But when you come to the summary tab, you can pick which scenario you want to populate the information. So that way you see the returns based on that particular scenario. And there's also some other levers you could adjust. So one thing we adjust is the acquisition fee. So on the acquisition fee, most times you're probably going to be anywhere between 1% and 5% of the purchase price. And it'll usually depend on the size of the deal. So we adjusted it to what we would put for that. And then also same thing with the splits. So if you do different splits, then you would just adjust these returns to whatever your company uses. So that way you have those numbers matching up. So that's the perspective we usually look at it from, and that's why we adjust the underwriting there. Then I'm going to come to the P&L tab. So one of the other things you heard me mention in stress testing was the escalations. So you want to adjust these percentages and see what the deal looks like at different thresholds. So right now I have a 3% rent escalator and a 2% expense escalator. And you can change these numbers. So you may play with it and say, well, what happens if I go 4% on rents? What happens if I do 4% here and 3% on expenses. So you can try some different scenarios out to see how the returns look at different points and see if they're, exactly where the breaking point for the property is. As you scroll a little bit further down on the P&L, there's a couple important things you'll see here. But the one that's most important, in my opinion, is your cash on cash return. So in the event that you're syndicating, which I'm imagining most of you probably are, you have to make sure that you're delivering a return to your investors. And at least a part of that return is going to be through cash flow. So one thing I always look at is row 55. You'll see highlighted right here. This is your cash on cash return on a year-by-year basis. So for anybody looking at deals in recent months, you've probably noticed that cash on cash returns have gotten a lot less attractive than they used to be. And that's probably just a sign of market conditions and where we are. But nonetheless, we still want to be looking at these items so we can make sure we're giving our investors something, so they have something to want to invest with us for. Okay, so then we have our acquisition cost tab. So our acquisition cost tab is generally our closing costs. So there are some default settings that are in here. Most times I leave these unless there's something I see drastically off. The things that I typically alter here are my taxes and insurance. So taxes and insurance, I usually put 12 months of each. The reason I do that is because at closing, you're probably going to have to pay the year one insurance premium in full at closing. And most lenders are also going to establish a tax and insurance escrow. So it's hard to say exactly how much they're going to take in the escrow. It's probably going to be somewhere between 3 to 6 months of their estimated monthly calculation. But I would tell you, it's always better having more money than less. The last thing you ever want to do is get to closing and realize, oh, I'm $500,000 short. That never works out good. Trust me, you don't want to do that. If you're looking at something that may have a loan reserve, you'll want to put that in too. So you can use this section here and adjust the amount of debt service that you want to keep in reserve. Most deals that I'm looking at this point, I'm factoring from an agency perspective, so there's no need to do this because I'm looking at it with fixed rate debt. But if you're thinking adjustable rate, I would tell you definitely factor something in so you have a cushion. And you also want to find a spot in here to put your rate cap. Last thing we'll do before we dive back into the end of the PowerPoint presentation is the exit strategy. So keep in mind, guys, it's often said in real estate, the money is made when you buy. There's a lot of truth to that because you can correct most mistakes. The one mistake you can't correct is what you bought at. But what you also want to do is look at the exit. Now, obviously, the exit's a little more uncertain because it's future looking, and there's a lot of assumptions that are made to get to this point. So this particular underwriting tool has the option to do both a refinance and also a sale. So with this deal, the way I was looking at it from is no refinance, but a sale at the end of year 5. So what you'll see here is in the sales section, it takes the net operating income for the property in year 5, and it shows you what our terminal cap rate is, and it comes up with a calculation for the sale price. So with this particular deal, we'd be buying it for north of 37 million, selling it for 56, and it's showing you all the different calculations that it made. So it has a sales cost, which is going to include your brokerage commission. You can also put your prepayment penalty in there. It's going to have the return of your member capital. So keep in mind, guys, if you're syndicating, before profits taken when you sell, you must return capital. So you have to return the principal to the people who gave it to you. And then at that point, you can start distributing profit. So that's what this slide here shows. Okay, so now we'll dive back into the remainder of the PowerPoint presentation. And here we have 2 little things that are worth touching on, especially in today's market conditions. So the first one here is an assumable debt summary. So if anybody's looked at a deal the last couple of months with a loan assumption, and I'm going to guess that many of you probably have because I've looked at a lot too, they're going to give you the terms of the existing loan. So what's different about an assumption than new financing? Well, when you go to your underwriting, right now in the scenarios tab, here I'm making some assumptions with a new loan. So the assumptions I have are that my down payment is going to be 45%, and the loan balance is going to be the remaining 55%. So what the syndicated deal analyzer does is if I change the price, let's just go random number here. So now I've increased the price from 175 to 195 a door. What happens is because I have that down payment percentage in here, the loan amount adjusts automatically. If you're using an assumption, it's going to be a little bit different. What will happen is you have a fixed amount of debt that you're assuming. So for this particular deal, it shows 16,458,000. So what that means is, regardless of where the purchase price is, whether it's 120 a door, 150 a door, 180 a door, I'm still assuming 16,458,000. That number is constant. It's not going to change. So just make sure you make note of that, so that way you can reflect that in your underwriting. And it's also telling us here what the interest rate is, what the amortization period is, and how much interest only is left. So that way you can enter these tidbits of data into your underwriting to determine whether or not the deal makes sense. And the next slide we have here is an insurance indication. So this was one of the things that I mentioned earlier in the items that you want to follow up on. So as you look at this, this particular insurance broker is one that I use regularly. They're going to give us different scenarios. So they're going to give us a high scenario, which is kind of the worst case, a middle, and a low. And keep in mind, guys, at the time you're getting the indication, there's very limited information that the broker has. So they're not giving you a formal quote. This is just a really rough starting point. All this is for budgeting purposes. But once you actually get a deal, then you'll have to give them more information so they can do a full process and get you an actual number. And then that's just my contact info, and I'll turn it back to Vinky if we have any questions.
Sure. Thank you, Charles. That was very informative. So I wanted to ask you one question here, just for my understanding as well. So when you're doing your assumptions, so at the high level thinking, what would you consider is a good assumption versus bad?
Well, it's a good question. So it's probably going to be very market specific and even very asset specific. But the first thing I would tell anybody in here is you want to get familiar with the market or markets that you're looking at. So the assumptions that you're looking at, if you're looking at a deal in New York versus Indianapolis versus Charlotte, are going to be very different. So understand the markets that you're looking in, and also build connections and relationships with people that are going to be experts in that stuff, so they can give you good assumptions to work with. Now, one thing I would tell you, and this may disappoint people, is that a lot of people use the expense ratio as kind of a gospel type thing. And what I mean by that is they're looking for it to be, give or take, near 50% of income. So that sounds really great for simplicity, but I find that's not accurate a lot of times. Because properties can be run very differently. And the thing is, if you have a higher income producing property, so let's say if you're looking at an A asset, even though you may have a higher expense per unit than you would like a C, you may actually have a lower expense ratio. And the reason for that is because your income is higher. So keep in mind, guys, there's only so much you're going to need to run a property. Now think of it this way. Let's say I'm looking at 2 C properties in the same area, and one property has an average rent of $900 and the other one has an average rent of $1,100. Let's say the properties are similar in size, and then I'm going to run them in a similar manner with on-site staff. Do you think my expenses per unit are going to be significantly different between those properties? So the answer there would be no. Your payroll cost is probably going to be similar. Good chance your repair and maintenance cost is probably going to be similar. The only difference is the income. And because of that, one is going to have a percentage that may look, right to some people and wrong to others. But what I would tell you is really dive in and get familiar with the expenses on a per unit basis in the markets you're in, because that'll give you a good competitive advantage as you're looking at stuff.
Thank you. And then another question I have is, I think Angel already asked that question, but I'm going to ask it again. Sure. Because when you're looking at T12 versus, T12 versus T3, right? So you took the T3 and multiplied by 4 and got the numbers. And what if somebody knows, okay, I'm ready to sell my property. So numbers could be inflated in the last 3 months, and that could just kind of throw you off if you're doing the 12 months assumption on that based on those numbers. And comparatively, if you're just doing T12, you might have a better picture. I know you can read through the numbers and every number tells you a story, but beside all that, numbers could be cooked up in some way that is hard to, calculate for the newbies, like for us, if somebody wants to come in and start underwriting the deal?
Yep. So the first thing I would tell you is that almost every seller will probably push the numbers as they're getting ready to sell. I don't know a seller that wouldn't. If they wouldn't, I'd question why. That being said, most sellers probably plan to sell 6 to 12 months in advance. So you could even argue in some cases 12 months before they may be having that end goal in mind and starting to push numbers. So the assumption I generally make when I look at a property is that I'm probably going to have to go in, and especially if it's a value-add property. Like if it's an A-class asset, maybe a little bit different. But if it's a value-add asset, which is what I'm guessing most people are looking at, I would assume you're going to have a healthy amount of evictions when you go in there. I would assume that the seller is just putting bodies in, because that happens a lot of times. A lot of times they slack off, or maybe they just aren't good operators to begin with, and they'll do what they can to make the numbers look good. So keep in mind, guys, you want to use the numbers in front of you as a starting point, but never an ending point. You want to use your own expertise. You want to use the expertise of your property management companies, so that way you can go in there and project accurately. So, keep in mind the broker, while they do have a lot of expertise, their job is to sell the deal. So they're going to give you best case scenarios, and in life, we don't always see best case scenarios. So just be cognizant of that, so that way you have, a good thought process as you're looking at deals and underwriting them.
Thank you. I think Ali has a question. Go ahead. Take yourself off mute.
Yes. Hi, everyone. So I have a question here. Regarding to the scenario, in the expenses, if there is something missing, like the advertising or turnover, or like legal stuff, legal fees or whatever. So in this case, when I do my projection here in the projected or the offer, did I still need to add this expenses from the rules of thumbs that I have it in my SDA spreadsheet, or because this is confused for me sometimes?
Sure. So it's a good question. So my general rule of thumb is that if the seller's expense is higher than mine, I probably leave theirs. If it's lower than mine, then I would use a rule of thumb. Now, keep in mind, when Michael Blanc made this tool and he put these rules of thumb, these are very general. So the numbers that you see here, these are all really going to change, and some of them can change widely by market. So in general, like I look in the Southeast, and most of the Southeast markets are fairly similar. But if I were to take these numbers here and then go use them in California or New York, I'd probably be way off. So just understand that while you could use the rules of thumb, they're not meant to be a one-stop shop, because you really want to contact property managers and see what they're telling you the rules of thumb should be for that market, so you can get familiar with them. So if the seller's expense is higher, I would leave that and then ask a question to get some context about why it's higher before reducing it. And if it's lower, then I would increase it, so that way you have enough money in there. It's better to be heavy on expenses than light, because if you wind up light, that can be very costly.
Okay, so sorry about that. So I tried that, and somehow when I added let's say the advertising, when I check the expenses on the T12, they didn't spend any money. It's very little money they spend on advertising. You know what I mean? So, and when I added the rule of thumbs that I have it here, it goes the expenses, it goes up. You know what I mean? Like it's really like, it's not only the advertising. It's advertising, it's legal stuff, you know what I mean? So like it's many stuff. When I add them, it's already missing, or they didn't spend, it's very low. So when I add the rule of thumb, the expenses really goes up because they didn't add this stuff. So
yeah, unfortunately, it definitely can do that. So, my approach to expenses, So the last couple of months, you hear a lot of people touting how much income's been growing, and there's truth to that. Unfortunately, what they don't tout is that expenses have also been growing just as much. So expenses have been going up quite a bit, and it's the less sexy side of the business, right? Because nobody wants to talk about that. So while it may be pushing your numbers high, it may be making them more realistic. Now, is it to say that a seller or an owner couldn't run a property lower? You could. So especially if they're not syndicating and they're a buy and hold person, they're using their own money. You know what? Maybe they don't have pest control. Maybe they don't care if, repairs are made. So there are things you can do. Maybe they're a mom and pop operator and they're doing all the repairs themselves. So the repair and maintenance cost is, a fractional amount of what it's going to be for us because they're not accounting for any of the time that they're putting into it. So there could be different reasons. Now, what I look at in the expenses also is I look at, okay, what can I change and what can't I change? So in general, I can't change taxes. I can't change insurance. Maybe you do a little better in certain regards, but you're probably not going to make drastic changes. Okay, but can I change repairs and maintenance? So maybe the seller had a high amount of repairs because they included some capital expenses in their operating expenses when they shouldn't have. That might just be an accounting issue, might not even be an operational one. So maybe as simple as getting them to change their accounting and modify that. So what I would encourage you to do is to think through each of the items as you go through them and think about, okay, well, what can I do here that can make it better? Is there something I can do that make it better? Because sometimes you can't. And what I would also encourage you to do is just speak with property management companies and really dial in what the per unit expenses are for the asset types you're looking for in those areas. And that way it'll give you a good starting point as you project forward.
Okay, thank you so much, Charles.
You're welcome.
So there is another question in the chat, Charles, from BH.
Yep. What cap rate assumption are you underwriting for sale and refinance? Reversion more likely in this economy? So my personal opinion is that I'm quite bearish right now. So because of that, my terminal cap rates have reflected that. So in general, what the syndicated deal analyzer is built to do, and many other underwriting tools are built with the same structure in mind, is that for every year you're in the deal, it takes whatever your current cap rate is, and it adds 10 basis points to it. So for this particular deal, down here in the current market cap rate field on the scenarios tab, I actually use a cap rate that's higher than what the market is right now. So this particular market where the deal's located, you could probably find deals in the 4 still. I personally don't think too many deals are going to remain in that range. So because of that, I'm using higher than current market cap rates in most cases. And because of that, it's giving some cushion. So I would certainly recommend that people use higher cap rates than what they've seen. I in good faith, I wouldn't recommend anybody use anything that starts with the 3 right here, even if your market is still in the 3s, just because it's probably not a bright move going forward. But, use some judgment, speak to brokers to see what cap rates are right now in markets, because that's where they're going to have a lot of expertise. And then based on the information you come up with and your own personal perception of where you kind of see the market conditions heading, use a cap rate that reflects that.
Great. If anybody has any question, please take yourself off the mute and ask now. This is your time. And our social media friends, if you have any questions, please put it in the comments and I can ask for you guys.
Hey, Charles, I have a question.
Yeah.
I've always considered cap rates to kind of be given by the market. I know they grow over time, but I see people manipulating them all the time. It's almost like they're cooking the books. So that's kind of confusing to me.
No, I think you're probably on point, actually. So they are given by the market, but the reality is numbers are what you make them. So if you want to change the returns, all you have to do is change 1 or 2 inputs and you can see a drastically different return. So let's look at this example here. So with this particular one, we'll leave a purchase price of $42 million and we're showing a terminal cap of 6. So our average annual return is 12.23, IRR is 11.22. Now just watch what 50 basis points can do. So all of a sudden, if I drop this to a 5, which puts my terminal cap rate at 5.5 now all of a sudden, my returns are 2 to 3 points higher. And that's 50 basis points. So your cap rates are given by the market, and they're larger than what any one of us can control. You know, I think people make the mistake of using cap rate as a return metric. And if you're buying the deal all cash, it can be, but I don't think too many of us are buying these deals all cash. I know I'm not. So, you know, the way that I use cap rate is I like to see what I'm paying in comparison to similar assets in an area. So if all the other C assets are trading at a 6 cap and I'm buying at a 4 cap, maybe I'm paying too much. So that's the way that I use it.
Yeah, but you said a beautiful thing there.
Yeah.
On the comps, you didn't comp it out to everything sold in the last 6 months. You
Correct.
comped it out to a like kind asset.
Right. Yep.
Because a
Keep
lot
that
of
in
people
mind, guys.
don't do that. A lot of people go with the broker and go with whatever sold recently.
Right. You don't want to do that. So if you're looking at a C property, guys, I wouldn't recommend comping it to an A property. You know, if you're in a small market and you don't have a lot of comps, you may have to work with what you have. But if you're looking at major markets like many of us are, you usually have enough information to work with where you can find something close to your property.
Well, thank you for making that distinction. A lot
You're
of
welcome.
people don't.
Yeah, I think that was pretty insightful. Anybody has any other questions? And our social media friends, if you have any questions, please put in the comment, or I put the link for the Zoom. Please join via that link, because we're going to go offline and we're going to do some networking here if there's no more questions. I do not see any questions on the social media. So over here, if we don't have any questions, thank you, Charles.
Thank you,
I
Vicky.
really
Pleasure being
appreciate for
here.
you coming, and then it was really, really insightful session. We learned a lot.